All right, let's get started talking about practice round one and maybe some of the things that went well and some of the things that did not go so well. So um, let's take a look here at some stuff. I'm gonna kind of jump right in, and before I show you my scores and announce which team won and all that other good stuff, I'm gonna go through the Courier. I had one team um, that requested some assistance because they didn't do so well, and that team will be evident, and so we'll talk a little bit about the performance there and maybe some of the issues that arose, and so hopefully I can address some of the questions that that team might have had, and then we'll talk about what went well for some of the other teams that did well. So um, when we start, I come here to the Courier. So, I'm going to log into one of your teams, and right now it's got me in there. I'll log into here, and it doesn't really matter, just to kind of show you what your guys' looks like, right? I imagine you come here maybe to the dashboard. It could be, maybe it's getting started. But anyhow, if we come down here to the reports, and the debrief reports should be what we want to look at. Analyst report, the round analysis, balance scoreboard. Wow, that's not what I really wanted to see. Industry reports, let's try that one then. I'm not that familiar. I don't often come to the team, and mine turns out and is a little bit different. But the Capstone Courier. You can also access the Courier through the Excel worksheet. You can log in using that worksheet, and then you can access the Courier using that. I kind of like to do it in this HTML format. The PDF is not a bad format either. PDF, then you could save it to your file, to your computer, to your whatever, and have it available, which might be kind of nice if you want to look at some stuff if you're offline or whatever, and you still want to kind of go through some of this a little bit. Be a good thing to do, but for our purposes, I'm going to do the HTML. Now, this is your Bible. Okay, for the rest of the semester, get used to looking at this. I'm going to, if you didn't win the round, I'm going to ask you questions that are going to come from the Capstone Courier. Almost 100% of the questions will come from here. Okay, the information that you need to be successful in this game is from the Courier. Okay, you need to look at it to help you make decisions and to help you do things. Okay, it's unbelievably important. Okay, and so please spend a lot of time looking at this, digesting it, massaging the numbers, working on things, looking at things. Okay, I might tend to kind of rip through it, right, because I'm pretty familiar with where everything's at. Forgive me for that if I do. Okay, and I'll try to take it kind of slow and try to there's a certain amount of bouncing around that I have to do because I see something and it says to me, oh, something happened there, I want to go take a look. Okay, and that's where I want you guys to get. I want you to look at some of the information here and have that ooh moment where you go, ooh, something's going on there, let's figure it out. Okay, and so let's start at the top here, and we'll sort of work our way down until I get to some of those oohs, and then I might do a little bouncing around. The very top of it just tells us what our team assignments are and whatnot. Then we come to the selected financial statistics, and this is always nice to look at the get-go. Okay, I don't get terribly wrapped up about ROS. Okay, return on sales. It's an important number. Okay, don't get me wrong. Ferris, by the way, is a computer run team. You see no students there, but the computer's going to run that team, which isn't me, but the computer. And so they had a 7.6% return on sales. That's off the get-go. I mean, net income divided by sales, right? And so that's a better number than anybody else. And so I'm thinking Ferris is in a pretty good position right now. But I don't typically spend a lot of time looking at that, nor do I look at asset turnover. Although again, Ferris obviously had the better number there. They also had the better ROA. an ROA, return on assets, is, yeah, okay. That can be kind of important. I can tell you this, in banking, we looked at ROA an awful lot because banks typically had very similar assets. It was like comparing apples to apples all the time. In this game, it's a little apples to apples, but not quite. And I think as the game progresses, maybe we'll demonstrate some of that leverage. Everybody's 1.9, 1.9, 1.8, 3.3. So we got a problem with Andrews. They had a little more leverage than they would have liked. And ROE, same thing, a negative for Andrews. Everybody else is pretty positive. Actually, this is pretty darn good numbers for getting started. Ferris, the highest, 20.8. Again, our computer team, not surprising. Okay, so you know the computer team will win the practice rounds. The computer team doesn't count when it comes to the assignment. So I'm going to pick the student-run team that had the best score. That'll be the team that's exempt from doing the assignment and gets an A for the week. Okay, but the computer team, we like to compare ourselves to them and see how they did. So they had a 20% or 20.8% ROE, which is awesome. You know, return on equity, that would be my investment in the company, right? And if I get 20% return on my investment any place, I'd do that all day long. I'd do 9 and 10. I mean, those are pretty good numbers. So, and 12 certainly too would make me happy. So let's come down and take a look at a few things here. So sales-wise, you know, Ferris, again, our team, our computer team led. You know, Chester's not that far behind. You know, that's actually fairly impressive for the first round. About an $8 million difference there is not that great, especially when we look at some of the other numbers here in a bit. And even the other teams, Erie the lowest, but not horrible. Okay. This is not a huge differential. We'll find as the game goes on that it won't always be the team with the best revenues or the best sales that wins. Okay, and there's a whole lot of stuff you can do to make money, to organize your company, to position your company, to do well without necessarily having the highest sales. And I think that, you know, to me, that's kind of the biggest and most important part of the game, is figuring out really how to position your company. I think so often we talk in business about, you know, how do you generate sales, that's really important. But this class, we're going to break it down a little more and say, you know, maybe we could do a few other things that would really benefit our shareholders, and ultimately that's who we want to benefit. So sales are pretty good. EBIT, then, earning before interest and taxes, and again, we assume Ferris is the highest, but Chester's not far behind, you know, just $2.5 million, and you know, positive numbers for everybody else. Profits, then, so we take out our interest and taxes, and profits went negative for Andrews, but everybody else pretty good. Really, that's not bad for the first round, not too bad at all. So cumulative profit it just adds what we had, and you guys all had the same amount when you started, right? It must have been about $4 million or something, and so we're adding to that. Now, SG&A to sales, this I like to look at, and it becomes important, too, in conjunction with contribution margin, and I'll tell you why. This tells you SG&A to sales is sales, general, and administrative expenses to sales. So for the most part, this is our marketing, okay, our marketing and our sales. Okay, and so when I look at this, I say, wow, Ferris spent 11.6%, and they had the highest sales. And remember, this is in a ratio to sales, so Ferris spent a lot of money. Okay, a lot more money. You guys have smaller sales and still had a smaller percentage. So Ferris spent a lot of money to generate its $140 million in sales, right? Chester, which generated $131 million, really good, only had to spend 7.1%, so a huge difference, 4.5% difference. Okay, that goes kind of to the bottom line. It goes to the EBIT, right? So really, that 4.5% difference, you know, is $5 million to Chester's benefit in terms of profit, or EBIT anyhow. Okay, it's a huge deal. On the other hand, contribution margin. Okay, your contribution margin is simply your sales. Okay, your revenue minus your variable costs, right? And then divide that number by your sales again to get the margin. Okay. You could do it on a per item basis, right? You could figure out a contribution margin, and we'll see below where that's done. But this is your overall contribution margin. 30% at the start here is a pretty good number to shoot for, and most of you guys are pretty close. Now, Andrews asked what things might they have done wrong. Well, let's look at the very start here. Their contribution margin was the lowest, okay, and there's some reasons for that. And their SG&A to sales was the highest, okay. You want them to be backwards, right? You want them to be the opposite of that. You want your contribution margin to be the highest and your SG&A to sales to be the lowest. I mean, that's in a perfect world. Does it work that way? Not necessarily, because it really depends on what your competition's doing. But you can see here that Andrews then probably has a real problem there, and there's some reasons for that. Okay, I'm stopping now if I'm Andrews, and I'm saying, well, why is my contribution margin the lowest? And in fact, I think that's one of your questions on your guys' assignment for the week. And so I'm not going to necessarily give you that answer, but listen up as we go through this, because odds are I'll probably disclose some of that. Okay, why is the SG&A to sales, one of the highest? Not counting our computer team. Okay, good questions, right? So this tells me a lot, and it kind of gets me going, and it gives me a, let's see, I do want to look at this. Chester had 4.5% better cost here, but 3% worse compared to Ferris in terms of contribution margin. Still, given that their sales weren't that far apart, Chester really had a 1.5% better margin here, combined margin. I don't know if there's a term for that. I'll make one up. I'll call it combined margin benefit, and that should have made them an extra $1.5 million or something like that. So and yet they lost by over $2 million. So I'm guessing there's some other things going on there, and you'll probably find that out as we go down here a little bit. The stock market summary, we're going to look at some interesting things. You're going to have a question right off the bat about the stock market summary, and we'll look at this especially as the game goes on. Chester and Erie did something a little interesting. You see, everybody started with 2 million shares, and 4 of the teams still have 2 million shares. Chester issued. Okay, they sold stock. Well, why did they sell stock? You sell stock to raise money, and you use that money for things, and they may have had some very good reasons to do that, but there's also an effect. Okay, when you sell shares, you now have more shares outstanding, right? Okay, so instead of 2 million shares outstanding, they got 2.36 million. That's a lot. Erie sold a few shares, not a bunch, raised a little bit of money. Oh well. Okay, and the rest of the teams, including the computer team, didn't sell any. Well, what's the impact? The impact comes down here to earnings per share. Earnings per share, I score very highly on. As an investor, I'm really, really concerned about earnings per share. I'm really concerned about earnings per share. Okay, that's the thing, as an investor in publicly traded stocks. Okay, I zoom in on that. Okay, that's about the first thing I ever go to when I'm looking at a financial statement is what was the company's earnings per share and what was it compared to last year and the year before, etc. Okay, so this is a big number. Okay, and so what's the impact here? Well, let's take a look. Okay, Baldwin had 2 million shares. Their earnings per share is $2.73. Well, how do we get that? Okay, I just want to demonstrate. Their profits here, right here on this line, profits were 5.451 million, right? Divided by 2 million comes up with 2.73 earnings per share. Okay, did you see how I did that? I take their profits divided by their shares outstanding, and I come up with their earnings per share. Okay, do that for Chester. But then your question that you're going to have for your assignment is, what would Chester's, I didn't phrase it this way, but what would Chester's earnings per share have been if they hadn't issued 361,409 shares? Okay, figure that out for me, please. Okay, debt. Bond market. We can go down, we can look. They didn't issue any. They didn't issue any. I can tell just because it's all the same, right? Ferris paid some off. Grapes, they paid off a lot of debt there. Interesting, right? Chester, on the other hand, actually issued a little bit of debt. Ooh, I like it. Using debt for some reason. We'll find out maybe why. But Ferris paid some off. Okay, and that's going to have an effect as we come down here a little bit. I'm gonna go down a little bit lower, and I'm gonna get to the income first. And I'm gonna go up and look at the other stuff in a bit, because I think the income statement's gonna drive me to some other things that I want to discuss maybe that are just above. But we come here, and again, the sales are what we had up above, right? Okay, variable costs. Don't get caught up in the dollar amount of variable cost. Your variable cost is the inverse, if you want to call it, of your contribution margin. Okay, so I'm more interested in the percentage than I am the actual dollar amount. And why? What do I mean? Well, Ferris had the highest variable costs. Okay, well, why is that? Well, because by golly, they had the highest sales. Okay, that's generally going to be the case. So saying that they had the highest variable cost is really meaningless. Okay. On the other hand, okay, in fact, Chester, look at that, they had almost as high a variable cost. Okay, but I'm more interested in the percentage, and so I come up here, and their variable cost, the inverse, so 68% of their sales, and for Chester, 71%. Right? And that's why Chester's variable costs are almost as high as Ferris. There's an $8 million, $8.3 million difference in sales, but there's only a $1.6 million difference here in the variable cost. Okay, and that's why, because of the margins. So I'm more interested in the margins. Okay, but I come down, I go depreciation. Ooh, Andrews has, that's 75, so 757, and theirs is lower. Okay, these guys I'm betting didn't do anything, Erie, Digby, and Baldwin, in terms of stuff, but Andrews and Chester have higher depreciation, and Ferris has lower depreciation. What's going on? Well, let's go find out. Okay, depreciation has to do with physical assets. Right? We depreciate things like equipment and machinery and those types of things. And so if our depreciation went up, and Chester's went up, a decent amount, really, especially relative to Ferris, who's went down, okay, that means that Chester, okay, I know this when I look at this now, Chester must have added some facility, whether it's capacity, machinery, equipment, those types of things. Andrews did likewise. What's that tell me about Ferris then? If I'm pretty sure that Baldwin, Digby, and Erie didn't do anything, Ferris maybe got rid of some facility. Really? Well, let's go up and see. I'm going to come up here to the, I could look at a couple different places, okay? I could look at my total fixed assets, because that's what we depreciate, and that might tell me. But I can also come up here to my cash flow summary, or my cash flow statement survey, it's called, but my summary of cash flow. And it's a good telling place, I guess, for this particular thing that we're looking at. Now, what I want to do, the cash flow summary tells me that I had cash positives or negatives depending on what I did, right? And one of the things I could have done would be investing activities, which may have been in plant improvements. And we'll look at more stuff on the cash flow, but I want to point this out for now because it's kind of a big deal. So plant improvements net. Net means it could go up or down or stay the same, and meaning that you could reduce your plant capacity like Ferris did in a big way. Look at that. They actually generated positive cash is what that's telling us. They generated positive cash because it sold, I'm guessing, sold capacity. They could have maybe sold automation. I'm not sure you're even allowed to sell automation, though, in this game, but in real life you could sell equipment and those types of things, which would be capacity, really. And so Ferris sold capacity. I know that when I look at that. Now, Chester and Andrews, on the other hand, added something. Okay, they spent money. They had a negative or money going out, right? Keep in mind, too, this is not an expense. It's a cash expenditure, but that does not make it an expense on your financial statement. It is, or on your income statement. It is not an expense, nor is this a profit for Ferris, although parts of this are considered an expense, just parts of it, and parts of this might be considered as a profit, just parts of it. And that gets back into how we handle it for taxes and whatnot. Okay, so Andrews and Chester, I'm pretty sure, probably increased something, and Ferris, on the other hand, decreased. Let's go look at the fixed assets, because that's where I'd see that, right? Total fixed assets, again, I don't think Baldwin, Digby, or Erie did anything, because their fixed assets stayed the same. Okay, but on the other hand, Andrews and Chester's fixed assets went up. Ferris went down. Interesting. Again, quite interesting, right? Okay, so it confirms that. The question that's in my mind now is, so what did they spend money on? Okay, because the two things really that you could spend money on would be increased capacity, okay, so the ability to produce more items, or you can spend money on increasing automation, which should then reduce your labor costs, right? So we might have increased automation, which can be a big deal. And I can tell that. Now this is where I start jumping around a little bit, so I'm going to apologize, but I'll come right down here to this production information, and might spend a lot of time on that. But I know Chester and Andrews here spent money, okay, and I'm thinking that it's either on capacity or automation. Kind of cool how they put them right together there. Okay, you guys all started with capacity that was 1814,966. Okay, I know that. So 1814,966, 1814,966, 1814,966, 1814,966. Ooh, 12,1,566. So Ferris did something interesting. Okay, I think you started with, I know that Baldwin, Digby, and Erie didn't change anything, so automation 45333. Okay, ooh, look here, Andrews 56343. So they increased automation. Didn't change their capacity, but they increased automation 56353232. Again, didn't change capacity, bought automation. On the other hand, okay, Ferris did, and this is where the net comes in, because they increased some automation here, 4.4, right? So 4.5 instead of 4.5333, they got 4.5344. So they increased some automation. They spent some money, but they also sold off a bunch of capacity, right? They sold off 600 units of capacity there, 400 units of capacity there, and 400 units of capacity there. So they sold off a decent amount of capacity. Interesting, okay? Interesting. Be something certainly that we're going to come back to and to talk about. So, okay, so I've jumped around a little bit. I looked at that income statement. I'm not quite done looking at the income statement though, because I looked at that depreciation. Remember when I said Chester actually had a little better net margin up above, or combined margin up above? Okay, but when you get to depreciation now, okay, which I was looking at, they had 8.8 million, which is an expense, 5.8 million for Ferris. So that's one of the reasons that Chester's income, net profit, was less than Ferris, even though they had a better margin, right? Okay, because of depreciation. SG&A, Chester had really low SG&A. Look at that, and this is back to that net combined margin thing that I was talking about. Okay, 9.4, 16.3. Okay, so $7 million difference there, right? Okay, and then we come down a little bit. EBIT, Ferris is a little bit better. Interest, remember Ferris paid off a bunch of debt. Okay, their interest is down. Chester added some debt. Their interest is up. Andrews had a huge interest here. Well, why is that? Well, the reason is because Andrews had to take out an emergency loan. Okay, Andrews didn't have enough money to cover their expenses. We'll talk about why. Okay, as we go through this, it'll become apparent, I think, and we'll talk about it. So, okay, so I found some interesting things. I confirmed some things in terms of the debt, in terms of the depreciation, in terms of the SG&A. Huge difference there, right? I mean, Ferris spent a lot of money to generate some sales, and they did. But Chester was very efficient about generating sales. Very, very efficient. Kudos, hats off to Chester for generating the kind of sales they did with such a low actual amount of SG&A. Again, remember how I say the actual amounts? I mean, while yes, they're kind of important, but remember Chester had the lowest at 7.1. I think Baldwin and Digby were, let's go up and look, 8.6, right? And yet Chester spent more money, okay? 9.4 versus 9. So Chester spent more money than Baldwin and Digby. You scratch your head and you go, yeah, but their percentage was lower. And that's why the percentage is important, okay? That's why the percentage is important. It's one thing to look at that, but what's that mean? Well, they generated 27 million more in sales. And so they were very efficient. Again, it points to the efficiency of that. I think I'm gonna pause this now. Actually, it's lunchtime, and I'm gonna go to lunch, and I'll come back and try to start up where I left off. So here we are. We have kind of completed going over the income statement, and I want to jump in again and kind of look at the cash flow here. So we're coming back up a little bit, and we're going to look at the cash flow. And I usually try to pick out big items. The depreciation we saw down below in the income statement, which really doesn't change. Accounts payable, well, if that would happen, maybe if we change our accounts payable policy, or maybe if we had huge increases in production or something like that. Okay, inventory is a big one. We come and we take a look at that, and we see, Ferris actually had an improvement in cash because of inventory, meaning that they actually sold off some inventory from the prior year. They're going into the next year now. Their inventory is actually going to be less than it was the prior year. Okay, and so that's kind of important, and the same would be true of Chester. Both of those are relatively small amounts. Just nothing real major. Okay, and even these amounts here changes, which would be the opposite for Erie, Digby, and Baldwin, is that they had a decrease in cash because of inventory, so they had a little more inventory, or they'll have a little more inventory going into next year than they did last year. But when we come down and look at Andrews, we go, maybe we're getting an idea when we see that of maybe one of the big problems that Andrews had, and why they had a negative profit. They had a loss. I don't think there's any such thing as a negative profit. That's like an oxymoron. Although, there probably have been some negative profits in the past, but that would be a religious thing that I probably am not allowed to talk about. Anyhow, so that may be a telling thing, and we're obviously going to want to take a look at that and see what happened there, right? And there'll be some spots down below where we'll do that. We saw the plant improvements we talked about, and that's kind of a big deal. I'd look at that. I would study that. There's not a lot to study, but I'd look at it really hard each round, because it tells you what your competitors are up to, right? Chester and Andrews are building up. Ferris actually shrinking down a little bit, maybe for a reason. Okay, part of the reason I want to look at that is I want to try to figure out as quickly as possible what my opponent's strategy is. Huge. If I can figure that out, it might give me a competitive advantage. And so I really want to look at that and try to figure those things out. Dividends paid, okay, resulted in a negative to the cash position. We had Ferris and Chester both paid dividends. Chester's small, okay. Sale of common stock. Remember we looked at that and we said that both Chester and Erie had obviously sold some common stock, and in Chester's case, $12 million worth, $12.3 million, so significant. Erie, just $500,000. Okay, so again, net cash in this case from financing. Andrews had to get an emergency loan of $48 million, huge number. Okay, and again, probably contributed some to their loss. So. What else on there? Cash from current debt borrowing. So, they paid down some long-term debt, but actually borrowed some money short-term. That's a little bit unusual there. Okay, if that was for Ferris. The balance sheet, I like to look at this, but it becomes more important kind of as we sort things out a little bit. Again, the inventory, it'll reinforce some of the things. The inventory that Andrews has got built up. While we see other teams with inventory, frankly, those inventory amounts aren't that great. Okay, I mean, you want some inventory, right? Going into the next year, you don't want to stock out on stuff. That's probably the worst thing that can happen. Accumulated depreciation we won't worry too much about, because we're worried more when we get to the income statement or the cash flow about the depreciation that happens right on an annual basis. Accounts payable, usually we don't see a lot. Again, we probably got a bigger number for Andrews. They very well might have produced quite a bit more than other teams. Given the level of inventory, we probably assume that that's correct, and so that's probably why their accounts payable went up. Current debt, Ferris borrowed some. We saw that up above. Theirs is the emergency loan that Uncle Al had to give them, according to the deal. Long-term debt, again, we saw the reduction there, and we saw some increases here. Okay, everybody else stayed the same. They actually paid some down. They actually added a little bit. And then common stock, and look at that. Okay, their common stock as a part of their owner's equity was up 30. That's because they started just like everybody else at this 18,360, and they added 12,3. Okay, so they almost doubled what their common stock is. Now, questions are going to come up too, and it's something to think about, and especially if you're Chester, you might want to think about it. And that is, well, what happens then to my ROE if that number goes up, if this common stock number goes up? Because what happens to your total equity? It's quite a bit bigger, right? So how does that affect return on equity? Something definitely to consider. Okay, and we've gone through the income statement. So I want to come down and kind of look at a few of these things. Okay, I can, at a real quick glance, what I'm going to tell you is that in the game entirely with all 6 teams, there's all kinds of excess capacity. Okay, what do I mean by that? Well, the blue lines, for the most part, are at least as long as the gold lines. You get 2 exceptions, and longer in most cases, right? Okay, and even where the gold lines are a little further, there's not much. They're not much further. Okay, and this is capacity versus production. Well, this is saying that they're actually producing more than their capacity, but you can't forget that we can have 2 shifts, and so this line, the gold one, bar, could be twice as long as the blue one. Okay, and that's when you would max out at capacity, production. I'm sorry. And so that's kind of extremely important when we look at this, and maybe that's why Ferris has said, we're going to drop our capacity. Remember, they sold some. We saw that up above. And we still have the ability to produce. And they could produce a whole bunch more than what they did. And they probably will as things go along. So this is worth looking at, glancing at, and asking yourself some questions. Now, if you're doing this, you're using some second shifts. So you're going to pay some overtime. It's going to increase your labor cost a little bit. But you're also going to save money on, if you come back up here and you look at Ferris, right? Look at that. They paid down some debt because they sold some capacity, so they've got less interest, and they got a whole lot less depreciation. Okay, and while depreciation is a non-cash expense, it is an expense. Okay, so important things to know. Now, we come down here in this production information. I look at a lot. I spend a decent amount of time looking at this. Of course, I spend a decent amount of time looking at all of this stuff, but this is a good, thorough report, and it gives us an idea. Remember, we were worried about Andrews and all their inventory, and this really tells you what their inventory was by segment. Okay, by segment. Yeah, excuse me, I thought I was going to have to sneeze there again, but okay. And so we know that they had a lot of inventory because it told us that in the balance sheet up there, and you can see where that inventory happened. It wasn't in the low end. Of course, they didn't make very many in the low end. A decent amount in the traditional end, but a lot of teams had inventory in the traditional end. In fact, Erie had even more. You know, even Ferris and Chester though had. So overall, by that I mean all the teams combined made too much in the traditional segment. None here, no inventory in the low end. And then lots of inventory here, lots and lots, and you'll see kind of what I mean when we go down there. You can get a quick comparison when you look at this of your products versus others. You know, if I want to see, for example, how my traditional product stacks up price-wise, I can go, well, 28, 28, 27 for Chester, 28, 28, and 29 and a half for Ferris. Okay, and you can go down and do that. There's places down below will be able to do that as well. You know, same with your performance, same with your MTBF. So it's a quick look at some of this stuff, but it's about the only place where we're going to see automation and capacity for our opponents. Okay, and you want to look at that, try to get an idea what they're doing. Okay, again, they've increased their automation. Remember, they invested some money, as did Chester, and so they've increased their automation in a couple areas. Didn't change their capacity. We know that Ferris, on the other hand, reduced their capacity. So, you know, I like to go through this. You know, here this is interesting. Low, they ran out. Low end, they're out. Low end, they're out. Low end, they're out. Low. Everybody sold out of their low end product. Interesting, and yet tons of inventory really in the traditional segment. Well, why is that important? It might be important for planning next year, right? You know, there are 440,000 plus about 400, so that's 840,000 plus 300. So there's 1 million plus nearly 400, 1.5 million plus 470, 1.9, you know, 130, 2.1 million units of inventory in the traditional segment, right? If I do my math, okay? So there's a lot. You know, I can calculate what my demand's going to be next time, and then I need to take off of that really what the inventory's there, okay? And so doing that kind of math is really important. On the other hand, there's no inventory in the low end. Nobody's got a low end product. So what's that going to do next round? We're going to have to make enough to meet the demand, okay? So spend some time on this production and kind of look at it. Look at your products. This is a good spot to look at your products versus others. It's a good product. It's a good place to look for, you know, entire industry trends. You know, like I was saying with the traditional low performance and those things, and look at where they're at. You know, and look at all this stuff. You know, and it's just really important. Tell you a lot about what's going on in the game. Okay, so when we come down here, then we get into the individual segments, and it tells us about those. And the stuff here is just, you know, again, tremendously important. You know, traditional, it tells us what our total industry demand was this last time. We met the demand, right? Next year's segment growth rate is going to be almost 10%, so we're going to add just about 800,000 units. So next year it's going to be 8.7, you know, million units, but we got 2 million in inventory, so that means that, you know, if everybody could put their heads together as all the teams together, they'd produce, you know, 6.7 million just to meet demand, right? Okay, but of course you would like to get a little higher, you know, market share if you could, and so you might want to make a little bit more. Okay, but that gives you, if you do that kind of math, it gives you a pretty good idea of what needs to be made. Okay, and then you can kind of gauge from there what your, you know, what your production ought to be, right? Okay, so we got to look at those things. We got to look at down here constantly. You know, pay close attention. This changes every year, right? The ideal age probably doesn't change, but the price is going to change. The ideal position is going to change, where that thing is on the perceptual map, and the reliability generally doesn't change, right? But the ideal position does, and the price does. So you got to be aware of that and constantly change your product to meet the customer needs. Okay, and you may find that you need to do other things, you know, to meet the customer needs. Now, it also tells you what order. Okay, in the traditional segment, this reliability isn't all that important. Okay, so if you let your MTBF slide a little bit, you might get by. Okay, and you might save a little bit of money on material costs if you do that. Okay, but age is really important, so you don't want to let the age of your product get too old in this case, right? Okay. Over here, everybody's kind of even. When we look at the low end, I'll show you an interesting feat there. In fact, it's one of your questions. But This tells us that most of the companies met their potential in terms of their sales. Their actual sales were just about exactly what their potential was. A little different for Andrews maybe, and just a smidge different for Ferris. Okay, Andrews actually gave up, it looks like, just a bit in the traditional end. And why is that? They made lots of product. Well, it's actually a little longer story, and we don't need to get into that yet. So then you come down here, and this is a little more ideal look, or a little better look at these products and where they're at, and why they are, why they sold, why they didn't sell, those types of things. It really tells you. Now, it's important to know that these top 6 products are all traditional products, and these bottom 6 were actually probably low-end products that happened to sell in that traditional segment. Okay, and they'll do that, especially now before these segments diverge. These segments, if you go back and you look at your moving perceptual map, they diverge throughout the whole semester, throughout all the rounds, right? But now they're a little tighter, and so you might have some more crossover than you will later, anyhow. And it tells you, which one was the highest seller. Cake. Well, why is that? Well, it had a pretty good date. It had the lowest price. Was price important? And price was the second most important, age being the first most important. And their age was pretty good. Abel's was a little younger, and age was important, more important than price, actually. But price was important. Ideal position was important. And this is kind of small here, but you can see Abel kind of was backward a little bit. And I almost don't know, you look at the coordinates, if they actually might have moved their product backward there. I don't know. Okay, and the ideal position is 6.5 by 14.7. Okay, and this is pretty close right here, right? Okay, and you have to remember that it was probably ahead of it, and that this is where they ended up at the end of the year type of thing. So revision dates can matter some as well, right? This revision date's July. This was in March. And so they, these two might have sold a little bit more than Abel, simply because they revised a little bit earlier in the year, okay, and Abel revised a little bit later. But that positioning, I think, was a big deal. Price, Ferris had theirs priced fast, was priced a little bit higher, and yet it still sold pretty well. It was at the top end of the MTBF, so that's a little bit of it. Okay, the reliability is not a huge factor because it's 4, but it's still a factor. Obviously positioned better than Abel. Age-wise, it wasn't as good as Abel, and they spent a little bit more, on the promotion and sales, and so, that's probably some of the reasons that it sold a little bit better than Abel, right? Got a little higher, and take a look at the other ones. If you're one of the other teams, you want to know where your product was in relation to the others. Now, in the low end, it's interesting. We kind of had an opposite thing happen here, right? Everybody sold out of their low end, and actually some of the traditional products might have sold down here in the low end, right, to cover up some of the need that was there. Now here, okay, price is the most important by far, and then age, and actually want it to be fairly old, right? Now, if you make changes in your positioning and whatnot, your age is going to get younger, and so this one's maybe a little backwards, okay? But we look over here, and this is important. Andrews, remember, they had the one product where they didn't have enough on hand to sell. All the other ones, they had too much, but in this one, they didn't have enough. And this gives us a rough idea here. So their actual sales were about 13% of the market, but it looks like they could have had about 19, nearly 20% of the market. So they gave up, right, 13 to 19, they gave up at least 6% of the market share. And the total industry demand was 10 million. So 6%, how many sales did they give up in terms of units? I'm not going to do the math for you, and I'd like you to be a little bit more precise, but that's one of your questions actually on your assignment for next week, right? What did they give up there because they didn't make enough? They actually had the highest potential of any team. Okay, why is that? Abel they had a low price, okay, one of the lowest. Their Acre was their product, but the team's Andrews, I'm sorry. Positioning was the same. Nobody really moved theirs. Age was the same, no big deal. Promo budget, yeah. sales budget. MTBF was actually a little about the same, okay, but they still had a higher. I wonder what the heck would have given them a little bit of an edge. That's interesting. Because Cedar was 20 and they were 20, and yet Andrews would have had a little bit of an edge. It says up here would have been close to Chester in terms of their total potential. Yeah, would have been very, very close. So they gave up 600, whatever. Oh, that's right, I wasn't going to give you the answer. In terms of units of sales times their $20 price, that's a lot of money in sales. Okay, a lot of money in sales that they gave up, and so that hurt them in that category, right? Okay. Again, good stuff. Look it over. This customer accessibility, customer awareness is what you get with your promo budget, right? And most everybody's kind of in the same ballpark there. Sales budget gives you accessibility, so where are you getting it out to? What kind of stores are they stocking it at? Those types of things. This December customer survey is where it's at then at the end, and you want this number to be high, okay? And maybe that's their number's pretty high here, so they got a good customer survey. That's interesting, yeah. Okay, let's take a look at the high end then. And I'm not going to spend as much time because I've kind of gone through it, but again, you kind of follow up, look at the stuff that's going on now. Andrews was the highest. They sold 604 units, but remember, they had a lot of inventory. Now let's look at it. The total demand for this year was 3,000 units. Okay, and I'm going to go back up to that production analysis. So in the high end, it was 3,000 units, and they made a total of 931, or because they had some coming in to the year, but they had available 921,000 units. So they anticipated that they were going to sell just about 30%, that they were going to have about a 30% market share. Okay. With 6 teams, if everything was divided equally, I mean, of course you want your market share to go up, but if everything was divided equally, you'd have, 16.666 market share, right? So Andrews was anticipating, or at least that's what they're telling you here by their production and whatnot, they were anticipating that they were almost going to double their market share, okay? And they did pretty well. They sold a bunch. I mean, they ended up with a market share of 20%, but do you suppose they were a little aggressive then in trying to figure, that they were going to get up to 30% and they got to 20%? Yeah, might have been a little aggressive. They were positioned well. Their price was good. It looks like they were, positioned pretty well here, which is important. Ideal position. Okay, ideal age 0 or as close to it, and their age is good and low. So they were positioned really, really well, and they sold more than anybody, and they had the potential to sell as much or more than anybody, okay? But they were anticipating that they were going to have 30% of the market, and that may have been a little unrealistic, right? I think that becomes even more pointed when we come here to the performance. Performance demand was 2,241. Well, let's go back up here and look at Andrews. So 2,241 in the performance, and they had 1,266. Okay, well, now I've got to do quick math here in my head, but that tells me that they were anticipating that somehow they were going to get 60% of that market. 60% of the market. Again, maybe that's a little unrealistic. Could you dominate the market? Yeah. Could you get big percentages? Yeah. Look at, they got 24% in a market. Not much change there. I mean, not much separation there. 20 there. Looks like that 24% is about the biggest. Well, there's 26 that they got here. Okay, but again, the problem here, they did get 26%, which is huge. That's the biggest market share. But in the size segment, they were just like in the performance segment. They anticipated, based on the production and stuff, that they were going to have 60% of the market. Okay. Can those huge numbers happen by the end of the game? Yes. Okay. But in the first few rounds, it's probably unusual that you would get 60% of any market. Okay, so you got to look at these different segments, and you got to judge and make judgments about what you really anticipate for your market share. Okay, the math, is not that difficult. You got, and it gives you what your market basically is going to be the next year. It's not perfect, but it should be pretty close, right? So the size is, this year was about 2,300 or 2.3 million. It's going to go up by 17.4%. So it's going to go up by, what's that, about 400,000 units. That's really rough off the top of my head. So that means it's going to go up to about 2.7 million units next year. Okay, so you might want to do some math and say, well, if I got 26%, maybe I could push that even a little higher next year. Maybe I could get up to 30%. That's still a pretty big market share. But if I could get up to 30% on 2.7 million, how many units then do I want? And then I have to also back out what I have in inventory. Okay, so you've got to, you really need to do that math then to make decisions about how many you want to produce and whatnot. Okay, extremely important to do those math things and try to figure that out. I'm sorry that I'm going to push you guys to do math and finance and look at numbers and all those horrible things that nobody likes to do except me. I really enjoy it. It's really a lot of fun. Remember we saw the actual and potentials here? Okay, pretty well balanced there, right? You come down here and it actually gives you the actual numbers. Okay, so now let's go here. For example, in the size segment, a gape or a gapey or whatever the heck you want to pronounce it, right? It had a total of 20 in the size 25.6%, and then Able took, how did Able get in there? Wow. Able actually sold a few, huh? That did, 9 units, but still it sold a few units, 0.4, which gave, okay, it gave Andrews a total of 26% of that market share. That was their total, or that was their total actual. Okay, their total potential was 26, so that's why it's even there. Remember, it was in the low end that Andrews was kind of weird, kind of off a little bit. So their actual was 9.7. Could have sold, or they did sell 2.3% of their traditional products, so 12.1. But their potential total was 19.3. Okay, so they missed out actually on that 7.2%. Okay, of the market. They missed out on 7.2% of the market in that particular case. So they missed out on quite a few units. This is a map that's going to tell you a lot. The perceptual map. I'm a numbers guy, and when I first started using this game years ago, this map didn't mean much to me. Now, as I've used it more and more, and students have pointed things out to me and whatnot, I find myself looking at this map a lot. Okay, the perceptual map. It tells me a lot. Look at it. It tells me my computer team is trying to get out here on the front edge. Okay, and none of you guys are even close. And I can tell you already after the first round, it'll be really hard to catch up. Really hard to catch up. Maybe impossible to catch up. That's how important it is maybe to get off to a good start. Maybe you don't want to, though. Maybe your guys' strategy is all something different. I'll let you decide that. But I can already make some guesses about Ferris's strategy. Remember, there's low cost, and then there is differentiation. Those are the two main strategies, and then they kind of break it down. Well, I'm kind of assuming if they're this aggressive out here that they're probably using a differentiation strategy. Okay, of one type or another. Of the 3 types, they're probably using one of them. Okay, and I like to look at this and follow along. Again, Able, this traditional product, being backwards of the other ones, that tells me they must have purposely moved it back there. Why, I don't know. Okay, I might have some guesses. There a lot of clustering otherwise. Looks like Chester's, they kind of got out here on the performance one. Kind of a weird positioning there. Kind of a weird positioning there too. But it's almost like they did those two backwards or something. Oh well. Okay. little review. I don't spend a lot of time on this one myself. Human resource that'll become important. I think next year you guys can start making decisions in HR, if I am not mistaken. So that's money that you can spend on training and those types of things. It can be very valuable over time. Okay, there are things like that TQM that come up that you make choices here early that might cost you money. Okay, might cost you cash, might be an expense even in terms of HR, in terms of TQM and those things, but it buys you long-term performance. Okay, and that's a big deal. It buys you long-term performance, and so that's extremely important. Pay attention, okay, to those things. Do some figuring. If I spend X, it's going to cost me a little bit here, but if it gives me a 10% advantage for the next 5 years or 4 rounds or 6 rounds or whatever, is it worth it? Okay, just do a little bit of math, and that'll give you the answer to that. So that's my rundown. Okay, I'll give you a rundown every round. It'd probably be shorter than this as time goes on, because I'll start taking shortcuts, assuming that you guys have learned your way around the courier a little bit. This first one pretty long, trying to get you into it, trying to let you see some of the things that I look at. I also I skipped over a lot of things. Okay, and especially from team to team. You guys need to study your team and see how it did. I'll tell you this though, that to be really successful, you'll study the other teams and know what they're doing. Okay, you should be able to figure out. After 3 rounds, we should have a pretty good idea what everybody's strategy is. Okay, so pay good attention to those things, and it'll make all the difference. Believe me, it'll really help you with your decision process if you know what strategy the other teams are employing. Because then you can kind of get a good idea what their tactics and whatnot are. Okay. So I need you to look at my scorecard, and I'll send this out. Okay, I want to show you which team won, and my scorecard, it's a little different. There's different scorecards, and you can look at the ones that the CapSim provides. I didn't like theirs. I kind of used it about the first year or so, maybe the first year, and I just didn't like it. It didn't emphasize the things that were important to me as an investor. And so I kind of created my own right or wrong or indifferent. I guess it's mine. I'll try to justify it. I also think that mine could still use some tweaking, and there's some things I should tweak on it. But you can see I copy information. This is that stock market report. This is the finance report, from the deal. And then this is the analyst data, and it's kind of cool. It's a big bunch of data that, if you want, you can just look at it on this, but you guys can get it as well. I have to go to reports, I think. Yeah, I'd have to get in to log into the team and show you, but I think it's maybe even right on the dashboard though. I'll go there and I think it's called the selected statistics. If you see something that says the selected statistics, I think that'll tell you. It'll give you this string of data here. A lot of this is the stuff we already looked at, right? They just put it into a different format, and so I just copy and paste this into a spreadsheet that I built several years ago, and then I've got my scoring parameters. And what do I emphasize? Well, top item is earnings per share. Okay, I care about earnings per share as an investor. I care about earnings per share a lot. Okay, that's kind of bottom line what I want to know. Okay, now that said, it works in this game that I can compare these. In the real world, I can't. Okay, in the real world, I can't compare earnings per share because share prices and number of shares outstanding and things like that are all different. Okay, they're all different, so I can't really compare earnings per share other than maybe as it relates to the price. Okay, and that would become kind of important. But in this game, because y'all started out with the same number of shares, okay, and y'all started out equal, I can compare it. It's a apples to apples comparison here. My next thing is ROE, and ROE might be more important if I was looking at a at a public company, right, where, like I said, the shares outstanding and those types of things might differ. And you can see my scores, the computer team, I got a 30 and a 25, so, and that's the most, okay. They get 30 points possible here, 25 points possible here, 10 points possible on the next one down is contribution margin. I make that a big deal because contribution margin is a huge deal. Okay, it's a huge deal, and I want to emphasize that because I want you guys to be working on that, and you know, you'll find that, you know, a percent here and a percent there will ultimately make a lot of difference. You know, you're starting out here with what, $150 million in sales, and it's a fast-growing industry, though. You know, it's growing at 14%, I think, overall. That means that it's going to double every 5 years. So in 5 years, you should be selling, you know, close to $300 million. Well, you know, 1% difference in the contribution margin is a $3 million difference in profit. Huge. Okay, huge. And so it's a big deal, and it's really, margins are what you know, CEOs get paid way too much, but millions and millions of dollars, you know, to try to shave or work on fractions of a percent in terms of their margins. And so, you know, it's an important deal here. Okay, Ferris maxed out there. Chester was actually low there, right? Not the lowest, but they were pretty low there, actually, surprisingly. And then stock price, and stock price isn't what your stock price is. It's how much your stock price changed from the last period or the last round. You know, it's the old, what have you done for me lately? Well, if your stock price just went up a bunch from, you know, last year to this year, that's a huge deal. That's really important to me for the last quarter. You know, like for example, Andrews went down to $1, right? Yeah, what if I you know, put $1,000 into that, and next year it goes up to $10? Woo, you know, that's a big change. That'd make me a happy camper, right? And so I'm interested in the change there. Profits, you know, I don't. That's kind of important. Again, as you structure your company, you'll see what I mean when I say that profits really aren't necessarily the most important thing, because it's profits as it relates to your number of shares outstanding, it's profits as it relates to your equity, it's profits as it relates to those things that might be more important to me, right? You know, Apple makes way more profit than Microsoft. It doesn't necessarily mean Apple's a better stock to own. It doesn't necessarily mean that that's a benefit to me as a shareholder. Okay, so we got to be you know, careful about that. You know, don't get me wrong, I like profits. Obviously, I give it some credence here, just not that much. Cash flow. This is just really saying cash flow is, again, it's only worth 5 points max, so it's not a huge deal. But I'm saying mind your cash flow. You know, don't really screw up on that. Strategy is my subjective thing. Okay, I generally don't change this. I might change it if a couple teams tie and I got to kind of pick a winner. Okay, I might say, oh, this one's adhering more to their strategy and take 1 point away from the other team type of deal. So what happened? Well, Ferris, our computer team, had 100 there. Chester has 87.75, so they're the highest of the student teams. Thus, if that holds out, and I'll show you why, but if that holds out, then they won't have to do an assignment. I have deductions though too. Okay, I have deductions for these things: an emergency loan, leverage, and working capital. Okay, emergency loans kind of self-explanatory. You know, if you didn't manage your cash, if you didn't manage those things, and you had to take out an emergency loan, that's a big risk. And so I'm going to dock you some points for that. Now, I give you a little leeway. You know, if your emergency loans happens to be really small, a couple $100,000, no big deal. If your team's doing well, it's just not a big deal. But if it gets over $5 million, then I'm going to dock you. Leverage, same thing. I really like using leverage, and using leverage can make a huge difference. Okay, you know, borrowing money and reducing your equity. Keep in mind the right side of your balance sheet writes equity and liability. So if you increase the liability side and reduce the equity side, you get a better chance to have a return on equity, which is a huge deal here, right? But it's also risky. Okay, here's where the risk comes into the scoring. You know, take your leverage to a certain extent, but once you get above 2.25, I think it is. If you get above 2.25, then I'm going to dock you. Okay, working capital, 20 million. Remember the definition of working capital is current assets minus current liabilities. Keep it above 20 million, or else you get docked. Okay, so that's basically my scoring. And yes, Chester was the victor. A lot of weeks you'll be able to look at it maybe and glance at just the Capstone Courier, and looking at that, you'll probably be able to determine who the winner was. There's going to be other weeks when it's really close, so pay attention. One thing you'll see that I've got future rounds, and this, it's just a spreadsheet that I've used in the past, and so these future rounds are actually from past years. So don't pay any attention to those, and make sure that you're on the correct round. Otherwise, if you come down here and look at the score and it's not accurate or it's not what you thought it was, that's probably the reason why. Don't pay any attention to this stuff over here. It's things that I had to put in to make my equations and stuff work out a little bit better. I had to get some decent sized equations in there to make that work. So, okay, so there's my scoring. So, what do you guys do for an assignment? Here it is, 3 questions this week. Here they are. What effect did issuing stock have on Chester's earnings per EPS, or earnings per share? Please provide a numeric answer. So I want to know, they issued 361,000 or something additional shares of stock. Okay, what effect did that have on their earnings per share? And if you went back in my video, I kind of demonstrated to you how to calculate that. And so, I guess I'm asking there is, would their earnings per share have been higher had they not issued that stock? Maybe. Okay. 2, why did Andrews have a relatively low contribution margin? Okay, contribution margin consists of these things. It consists of price minus variable costs. Okay, that's really your gross profit, and then you got to do the calculation to figure out what you got. The gross profit divided by your sales gives you a revenue, or whatever gives you the contribution margin, right? And so those are the only factors. So was their price too low, or were their costs too high, or what combination thereof? Okay, I might even give a bonus here if somebody comes up with a more specific answer. You probably have to dig through your guide if you can really find that specific answer. Okay, about how many units of sales did Andrews miss out on in the low end segment? This gets back to that actual versus potential thing. Okay, take a look at the actual versus potential, and make sure that you kind of do that math. I said about, so I'm telling you, probably in this one, if you look up at the chart and you kind of make a guess as to how many, what percent they missed out on, fine. In the future, I'll ask you to go down to that data where you could get exact numbers, and we'll do exact numbers there, and come up with some answers. Okay, show you how to do those types of calculations, and I'll probably walk through some of those as we go through before I actually assign those. So, okay. I hope that gives you a good idea what the assignment's going to be and whatnot. I'll send that out, and I'll send out the winner spreadsheet to give you guys an idea of my scoring and who actually won. So with that, you probably have questions. Please email them to me. Give me a call. Stop in if you happen to be in Havre. That's fine. Remember that next decisions are due Sunday night. Get them in there.